Welcome to Liberation Day in the markets, everybody. We have a very eventful day ahead. We're going to be getting this big tariff announcement at 4 p.m. Eastern time today. The markets are all over the place. A lot of investors are freaking out here saying, oh, is this going to be what takes the market down another leg, or is this going to mark the bottom? In this video here, again, we have some very bold statements from Fundstrat and Tom Lee going over what their expectations are for the market and really breaking down things that I don't think a lot of people are looking at as it relates to the broad market at this current time. So we're going to play this clip. We're going to go over all of those points. I'm going to add some of my own commentary to this as well so that you guys have a better understanding of not only what to expect today, but also in the next couple of coming days and weeks. So guys, again, if you do enjoy the information and analysis that I provide for you guys in these videos here, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot in spreading these videos out to as many people who actually want to learn. Let's see if we can get this video to 500 likes. That would be absolutely awesome. And again, make sure you guys are subscribed and turn on notifications if you never want to miss another video like this. We're almost at that 90,000 subscriber threshold there. Would be pretty great to hit that before May, which is when my birthday is. But without further ado, guys, let's roll this first clip.
How does President Trump want the stock market to react to Tariff Day? Let me give you some context. Even today, at a White House press briefing, Fox News asked Leavitt, the press secretary, has Trump heard from retirees in Florida stressed about the wild swings in the stock market? And she answered that President Trump takes those concerns very seriously, especially people's savings and 401ks. Well, our view is that there are 6 reasons President Trump wants the stock market to rally after the tariff deals are announced. The first is that this is a public validation of his tariff negotiations and strategy. Politico had a story today that if the White House does end up having an adverse reaction, they're going to try to blame it on Commerce Secretary Lutnick. And in the article, they talk about how if there are fallout from the tariffs, they're ready to play the blame game. And part of this has to do with the fact that there were moderates like Bessent who wanted measured approaches to tariffs. Of course, Navarro has always been very radical, but it was Lutnick that was also pushing for some aggressive tactics. And finally, we also know that President Trump has really enjoyed the uncertainty because that has also brought other countries to negotiate. And that's already happening. Israel is eliminating tariffs on American goods. Mexico and Canada plan to announce something on April 3rd. And even with the UK, there's been discussions how free speech is going to be intertwined with any discussions around tariffs. The second reason President Trump wants the market to react positively is that there's already waning support. It's showing up in voter approval ratings, in ISM surveys, and the consumer surveys. March ISM today had some nuggets. Tariffs are causing minor ripples in securing supplies with purchasing orders. Okay. In the electronics space, customers are pulling orders due to anxiety. In machinery, business conditions are deteriorating at a fast pace. In miscellaneous manufacturing, sales are lower from Europe due to the threat of retaliatory tariffs. The third is that if the stock market crashes, we're probably going to have a recession. I don't think that's disputable. But keep in mind that the average fiscal stimulus in a recession is about 2.2%, which is what the government had to spend, or $700 billion. These are all the recessions since 1929. And you can see roughly the amount of fiscal stimulus to come out of the recession is equal to the size of the decline in the economy. It's 1-to-1. And the average since 1929 is 2.2%, or $660 billion of fiscal stimulus needed. Think about that for a moment. The U.S. government would have to spend $660 billion to come out of a recession, which is actually the actual expected annual tariff revenues. It would kind of be an offset.
So as you guys heard from Tom Lee in that clip there, Donald Trump is most likely watching the market for a variety of reasons that I think are very important to dive into a little bit further here. We've talked a lot about this growth slowdown, this sentiment deterioration in the market right now, and in order for the market to really get a lot of that confidence back, well, it needs more guidance on these tariffs, and we are going to get a lot more of that today. But when we move over here and start talking a little bit about this projected growth slowdown that has been all over the media recently, the latest estimate from the Atlanta Fed is negative 3.7% for 2025. That is not something that we really need at this current time here. Now, when we move back over to what Tom Lee was stating over here about this necessary stimulus needed if we were to go into a recession in order for us to get out of it here, well, we see that on average, recessions since 1929 have demanded around 2.2% of GDP in stimulus, equating today to roughly $660 billion, nearly the amount the administration expects to generate from tariffs if that is actually generated. Tariffs will likely raise much less money than the White House projects, economists say. White House trade advisor Peter Navarro estimated the U.S. would raise about $600 to $700 billion a year from tariffs. Economists say the true number is probably less than half that sum. Much depends on the actual policies. Now, this is something we've talked about a lot too, where after today, we're going to have a little bit more guidance from the Trump administration and potentially a lot of these other economists too, maybe even changing their tune after we understand what the full scope of these tariff announcements are actually going to be. And speaking about some of the uncertainty surrounding this new tariff announcement, a lot of people are sitting on the side of the fence where they believe that a lot of these new tariff initiatives are really part of a broader plan to use these kind of threats of tariffs as a negotiating tactic. And you are starting to see some people coming to the table today. We have Ontario Premier Ford, Canada willing to remove tariffs if the US does. Yesterday, we also saw Israel removing all tariffs on the US in reaction to these new kind of widespread, wide scope tariffs being floated out into the marketplace. Now, is this something that could start to unfold and spread a little bit more over the next couple of days here if Donald Trump sticks to his guns today and does end up putting on these aggressive tariffs on a lot of other countries? Well, it is very possible that that does end up happening, but that type of uncertainty over what happens next is driving a lot of the sentiment as it relates to not only the market, but also the consumer sentiment as it relates to the economy. And as we can see by this chart right here, again, consumer sentiment has been falling off an absolute cliff since the end of last year. Now, we also have to talk about this credit rating situation, and that is actually an interesting point brought up by Tom Lee in this macro minute that he released this morning here. And when we think about this, and again, we actually did receive some news on this today here, but it was in the opposite direction. We could see a U.S. credit rating downgrade this year, says PIMCO. Now, in order to really think about whether or not this is a likely scenario, well, obviously we would have to avoid a recession. The U.S. is not going to get its credit rating upgraded if the U.S. economy is not doing well at all. But looking back historically to some of the reasons why the United States credit rating was downgraded, this provides a little bit of an interesting insight here. So in July of 2020, Fitch Ratings reaffirmed long-term foreign currency and local current default ratings at AAA, but revised the outlook from stable to negative. Fitch noted that the U.S. benefited from issuing debt in the world's reserve currency, but highlighted that the U.S. government had the highest debt of any AAA-rated sovereign, and there was no credible fiscal consolidation plan in light of the economic shock caused by the coronavirus disease 2019-2020 pandemic. They predicted government debt to exceed 130% of GDP by 2021. And when you think about what the actual debt to GDP is in the United States right now, it's sitting at 121, 122% here. So again, we have seen this increase, and this is a risk moving forward here. But what I want you to think about is, what are the actual goals of this new administration here? Well, it's to become a lot more fiscally responsible, balance the budget, decrease the deficit. Okay, so when you put that into perspective here, if some of these new policies from the Trump administration are effective, something like this could be on the table in the future. Is this going to happen this year? Most likely not. These things do take time in order to actually play out. And again, we don't really necessarily know what the effects are going to be over the next couple of quarters of these tariffs yet, because we haven't really gotten the full picture of what these tariffs actually are going to look like. So the market in the present, guys, has really been overreacting and almost kind of pricing in the worst case possible scenarios of these tariffs here. And what are those? We would see higher inflation, lower growth, and increased unemployment. We're seeing that in a lot of these 1 year and kind of longer term inflation expectations. You are seeing that in a lot of these growth projections. And obviously you're seeing that in the price action of the market here. Now, again, with a lot of these other kind of different factors that we've been looking at here, well, what is the most likely outcome? Well, it's probably going to be something in the middle, but what the US and the Trump administration really needs to look to avoid is a significant growth slowdown in the present. Now, what should we look at moving forward? Now, I'm going to have another video out for you guys tonight, kind of going over all of these new tariffs and the effects of them that we would expect to see. Now, what I really want to hear and get a little bit more information about this evening is, are we on the hook for more tariffs coming in the future? If we are, well, the markets are probably going to remain volatile and uncertain over what is going to happen next. If not, again, we did receive a little notice today through the news feeds that they are going to start kind of working through a new tax plan. And as we heard a couple of times in the past, it is possible, again, we would have to see again what the effects of these tariffs are going to be and everything else that this new administration is working towards. But there has been floated around the idea of nobody making $150,000 a year or less paying any taxes. If we end up getting significant tax reform, you can stimulate the consumer that way. If Bessent can come out and start to deregulate the banking sector as well, like he has said in the past, well, that could provide a lot more positive landscape to the market heading into the end of this year than a lot of investors and market participants are currently looking at right now. But as you guys in the Discord have heard me say many times, I'm really looking at this as from a wait and see perspective. A lot of people are worried about this market. A lot of people are coming out with overly bullish stances, but I'm just going to wait, see what this data actually looks like, and then make some decisions from there. So guys, that is going to wrap up this video here. If you did enjoy the information and analysis that I provided for you guys in this one, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot in spreading these videos out to as many people who actually want to learn. And again, if you never want to miss another video like this, make sure you guys are subscribed and turn on notifications so you're notified every time these videos go live. But until next time, guys, I will see you. Peace.